Yeah, so I guess I've done a couple of joint ventures over the years. How many people here know what a joint venture is? Just okay, good. Okay, so we're at least starting from the right place. I'm going to be talking about basic joint ventures. So this isn't going into corporate structure. I'm not going to talk about LPGP because I want to introduce the idea of joint ventures to you guys because I'm guessing some of you are at that point in your portfolio growth where you spent the available resources you have, and now you're wondering, should I hold pat, or should I start partnering up with people, utilizing their capital to acquire more properties? Anybody at that stage right now in where they're at with their portfolio development? Yeah, exactly. I hit that wall too. In fact, I've used $4.5 million of other people's money to buy real estate over the last 10 years. So I'm going to go over a few basic things that you need to know if you want to start doing this. Now, this is a presentation I actually had the pleasure of giving in 2015 at a large investing club in Vancouver. Now, I've tweaked it a little bit, but because it is the fundamentals and the basics, a lot of it is the same. Back when I first started doing presentations regularly on a monthly basis, I just thought that this kind of blue color scheme was the coolest template in all of PowerPoint. So I just figured I'd bring it back one more time. This is like the frosted tips of PowerPoint slides for me. So this is a joint venture. A joint venture is like baking a pie. And the reason I like the pie analogy is because then later on in my presentation I can use a pie chart. Alright? Now here's the thing. When some people have all the ingredients they need to bake a pie, and they know how to bake a pie, that's great. That's what it's like buying a property with your own money. But eventually, you're going to get to a point where, metaphorically speaking, you know people with ingredients, you know how to bake a pie, everybody wants to eat some pie, so in order for everybody to get a little bit of pie, you partner up, you give me the ingredients, I'll bake the pie, we'll cut the pie up in a way that is a win-win, and that we're both happy with, and we work together towards a common goal, and that goal is profit. So obviously the pie in this metaphor is the profit that the venture creates. Now, a typical deal structure that we see very often is that 50% of the profit goes towards the cash. Who's putting in the money? 20% of that deal goes towards the financial liability. So who's taking on the risk, who's putting on the name of the mortgage. And then 30% of the deal goes towards the deal management. Now, is this a hard and fast split? No. I can tell you that I have done deals where my joint venture partners put in 50% of the cash and gotten the mortgage. I did the work and we split 50-50. I've also done very, very large deals where we've had one signature investor put in well over $1 million, and because our ability to leverage one partner with that much money was so valuable to us, you know, we pushed it closer to a 75-25 split. Because ultimately, at the end of the day, the money we were able to generate for ourselves as managing partners made it worthwhile. So I'm going to kind of intro what we're going to talk about here first. So we're going to talk about stake. That's great. No. We want to learn that was the wrong order. Okay, so we're going to learn about deal structure. We're going to learn about the timeline for doing a deal. Because if you don't put first things first in a joint venture, you can have all kinds of problems. We're going to talk about that later in the presentation. And we're going to learn the tasks a project manager will complete. So, Rain uses the language, I still think they use like money partner, working partner. I like to say project manager and equity partner. You can say equity partner, working partner, equity partner, expert partner. At the end of the day, you're going to have somebody on this side of the equation who's bringing expertise, work, energy, and a deal to the table. And on this side of the equation, you're going to have somebody with cash and often borrowing power, the ability to take on a financial risk. My goal is for you guys to understand how to build a joint venture. I'm not going to be going into the minutia of sales skills. I'm not going to go into the minutia of what you're going to say to somebody in the middle of a presentation. I have a presentation like that. It's actually in the Mogul Mastermind deal archive, or presentation archive. You can check it out on the website. But today we're going to talk all about high-level structure and timeline. Now, every joint venture starts with a business meeting. So one of the most successful tools I have in a business meeting, this is going to be a little tip from me to you, is order the person you're meeting with a really strong espresso drink, because everybody's in a better mood when they've had coffee. I'm not kidding. I always have coffee meetings as my first encounter with a joint venture partner, because as that drink goes down, the excitement level in the presentation can go up. And it really helps. It really does. And the thing about the meeting is, I'm not, like I said, talking about how to present, but I want you guys to realize that joint venturing, by definition, involves a relationship with another person. You need to go out there and meet people. You need to talk to people that you've already met. And you need to talk to those people about how and where and when you can do business together. Because if you don't, you're not going to be able to have a business partnership with that person. But the big conundrum that most people run into early on is what I like to think of as the chicken and the egg challenge of joint ventures, which is, should I start with a deal first or should I start with a partner first? And allow me to explain what that means. I'm sure a lot of you heard the phrase, if you find a good deal, the money will come. Which isn't untrue, but if you're doing a residential deal, somebody who's done a deal recently, just shout out what your condition period was and the number of days you had. 7 days, 10 days, that's about right, that's enough. 6 days. So do you think you can go from, hey, how's it going, I'm James, to give me a check for $100,000 and sign this 25-page JV agreement in 6 to 10 days? I think the answer is no as well. So my preference is what I like to call the partner-first approach, where you come up with a deal in principle, you do a deal profile. So for example, Linda just presented a really sophisticated deal. She doesn't necessarily need to have a house pending in order to present what she presented. What she presented could be very easily adapted into a great joint venture presentation. So now she can have somebody agree with her in principle that yes, I would like to do business with that kind of deal on that kind of house. Great. Now that there's a bit of an agreement there, she can go and start pursuing houses. Because it's very, very stressful to try to close a deal on a short timeline when it's already pending. Now, if you find the absolute blow-your-mind deal of the century, yes, a partner will come. But I still would advise having multiple conversations with multiple people who might be interested in partnering with you so that at least that foundational work has been laid. So that if you say, hey, I've got a smoking deal and I know it's a short timeline, but we've already gotten to know each other and we kind of have an idea of how we want to do business, well, now you're ahead of the game. So here's an advanced technique, and I call this the post-close joint venture. So if you already own a property, let's say for easy math, it was a $500,000 property and you put $100,000 down and you own it for a little while and it's performing, well, you've put your money into that house. What you can do is sell a 50% interest in that property that you already own to your joint venture partner. They can repatriate your capital, which is the fancy way of saying they cut you a check to replace the money that you put in. And now you have a new $100,000 that you can roll forward into the next deal. So if the timeline piece, those are the dollars that come out. So the next piece of this is if you are a little bit nervous about timeline and you have the capacity or a portfolio that you can work with already, this can be an advanced strategy for getting that timeline piece out of the equation. But for the sake of this presentation, let's assume that you're not in that position. Let's assume that you're doing your first or second joint venture and you want to know how to get this thing to go. So here is the timeline of a well-crafted joint venture. Phase one is going to be the foundational phase. We'll get into that. There's going to be a triggering event that pushes you into phase two, which is the acquisition phase, buying the property. Then there's going to be a triggering event which gets you into the management phase after you close the deal. Now, phase three ends when you exit the property, split the profit, and feel good about yourself. So, phase one, foundation. Here's the outline of what should happen in the foundational phase. You should be doing a JV presentation, pre-qualification, calculating the ROI, signing a letter of intent, getting a deposit from your partner. Legal paperwork should be in review. They should be getting a mortgage pre-position, and you should be starting your property search. I realize this is a very text-heavy slide, but there's a lot to do. And if you don't do all of it in the foundation phase, you're setting yourself up for failure in the acquisition phase. During the acquisition phase, the offer should be made and signed, obviously. The deposit should go to the seller or the seller's brokerage if you're going through a realtor. The deal should be transferred into the final buyer's name. So there are some joint venture strategies that involve putting the property in your partner's name and having them close different financing options. That is a conversation that you want to have with the green team because they have a great level of sophistication with investor-specific deals. They can walk you through the minutiae of that. The JV agreement should be signed before you have a done deal. And I can tell you right now, I am coaching one of my clients who did a deal on a fourplex I'm not going to go into more information because you might be able to guess who it is, who did a deal on a fourplex, basically on email as the closest thing they had to an agreement in writing on the property. Deal closes, 3 months, 4 months later, she has a joint venture agreement, he's not signing it, and now things are starting to roll down a hill quickly because that joint venture agreement wasn't signed before the deal was done. So, important step. Again, you've got to put first things first, because if you don't and you skip a step, you're going to have problems later on. Financing is obviously approved, otherwise you're not going to remove your conditions. In phase 3, the management phase, this is where you're going to execute your tenant management, or you're going to manage a property manager. You're going to be paying property tax, insurance, and utilities, managing the repairs and maintenance, doing the banking and the bookkeeping, paying out cash flow in regular intervals if that's part of the agreement you have with your partner. Reporting to your partner is obviously critical, and then managing whether or not you're going to have an exit or a continuation. So I realized that was a lot of slides. That was a lot of information. Some of you are taking photos. It's kind of like a lot of content, like buckle up. It's like drinking from a fire hose. I'm making this presentation jam-packed. Even though it's surface level, I'm going to give you a lot of information in very rapid and short order. So the best thing to do about that is go to mogulrg.com to the Mogul Mastermind section and download the slides so that you can watch this presentation in the video and review it, and then follow along with the slides. Because if you think that went quick, I'm about to go a heck of a lot quicker. So, getting started, pre-qualified. You're not just, this isn't pre-qualifying at the bank, this is pre-qualifying your partner. Guess what? Not everybody with money is someone you want to partner with. I know that seems surprising, I know you really want to do a deal. If that isn't connecting with the person, everything that's built on top of that is going to be diverging further and further away from one another. And I can tell you in 5 years when it's time to exit, that's when things can really go off the rails. I'd like to talk about their previous experience with real estate. You know, are they the kind of person whose cousin's uncle's brother had a tenant trash the place and, ugh, tenants are the worst? Or are they the kind of person that's open to doing a deal, or open to doing something creative, or open to taking on a difficult challenge, and they have a risk tolerance to do that? Again, you need to know this stuff to know if they're going to be a good fit for the kind of deal that you want to do. Because if you're flipping junk properties in challenging locations and their risk tolerance is like 0 out of 5, that's probably not going to be a good fit. What's their available cash? Obvious, but you got to ask it, because if the answer to that question is $0, they're probably not going to make a good partner. You want to know what their ROI expectations are. If they're going to be super happy with 8 to 12%, then they might be a great candidate for a lower risk property that's a lot more stable. If their expectation is in the high teens, you have to make sure that you're setting the expectation early that high rewards often get associated with higher risk. And so you have to make sure that they're ready to go there with you. Timeline and exit expectations. If you have the idea of buying a buy and hold on a 5-year term and they want their money back in a year, again, you have a disconnect. So you have to think about either changing your strategy and crafting a deal that works for their expectations, or finding another partner. You need to know this stuff up front, and I like to have this conversation very early on in the process, because you can waste a lot of time having coffees and shooting the breezes with someone that you think is going to do business with you, and then when you finally work up that courage to ask the hard questions, you're like, oh, well, that was a month of my life I'm never going to get back. So have this conversation early. This is while you're building a personal relationship, you're also building a business relationship, and you want to get down to business. Make sure you know the risk tolerance. We touched on that. Previous experience. I said it twice because it's so important. And what are their reporting expectations? Do you have the kind of partner that's like, give me an annual report and I'm pretty much happy? Or are they the kind of person that is a little bit nervous and they have a little bit of a control thing going on, and they're going to be calling you once a week asking you, what the heck is going on with my property? What are you willing to do in terms of reporting for the entire duration of that project? Because if you don't want somebody who's going to be micromanaging you, or asking you too many questions, or just questioning what you're doing, or they're not happy with a report at an interval that you're willing to fulfill, then again, it could be a poor fit. And what's the involvement expectations that they have day to day? The fact of the matter is, somebody with an inexperience in real estate, when they think they're helping, they're probably just getting in the way. And so if you're the expert partner in the relationship, you want to make sure that you stay in your lane by making this deal happen, by managing this project, and they stay in their lane by providing their input, providing the capital, doing the investment, and then getting on with what they need to do. So, an important part of phase 1 is calculating return on investment. So there's 4 ways we make money in real estate. This is kind of a key spire thing. We've got cash flow, mortgage paid out, market equity, sweat equity, call it forced appreciation, whatever you like. Those are the 4 profit centers that are going to happen in a deal. So you have to be able to add those up and then divide it by the amount of money that got put into a deal. So how do we project into the future, calculate what the mortgage paid out is going to be over the duration of that project? That's pretty easy. Simple mortgage calculator on Excel will do that for you. You need to know what the rental market growth is going to be. Now, you can't know that. Nobody has a crystal ball. But you have to be able to make a prediction that you feel is accurate. Don't overpromise and underdeliver. Underpromise and overdeliver. That's just good business. So, know what the value appreciation is going to be in your marketplace. You know, the last couple of years in Edmonton, we haven't seen a lot of appreciation. So, if you're building a financial model for projects in Edmonton, use a conservative number because that's what a lot of partners are going to see. And then budget in the renovation value. So if the renovation is part of your business plan, you're going to spend money on that reno, know how much your money it's going to add to the house, or as all of you householders like to call it, your ARV, after renovation value. Add it all up, and then divide it by the total amount of money invested. That's going to give you your ROI. Now, you also need to prorate that for each partner's share. So one thing I see kind of clever joint venturers do is they say, oh yeah, this project is going to have a total of 108% ROI. Until you divide it by 2 because it's a 50-50 split. Now you have a 54% ROI. So make sure you're clear with what each partner is actually getting, and you are clear with that in your presentation. You also have to define investment. We've got the return part down. We want the investment part down. So here are some suggestions. Easy one, obviously the down payment is going to be part of the investment. Are they getting inspections? Are we paying for appraisals? What are the legal fees? What is the reserve fund that's being put in place? Are there transportation costs? A lot of my joint venture partners are from Vancouver, Victoria, Toronto. And we have rolled their travel costs in for doing the deal into part of what the initial investment is. So wherever you're going to define the investment, I personally think any money that gets spent to get the deal done counts as the investment. And then when you exit the deal, the investor's investment should get paid back first before any profits. Obviously, that makes sense. Now for me, when I think about crafting a joint venture, you want to make it a win-win. That's like one of the core backbones of doing good business, is that you have a partnership where you can't make money unless they make money, and they can't make money unless you make money. That's the point of a profit share. But the double-edged sword of a win-win is a lose-lose, just like old yellow shirt, whoops, that's where I'm going. Old yellow shirt and green shirt here. You know, they're tripping, guess what happened to this guy? He's going down. That's the thing that happens in a 3-legged race. You win together, you lose together. So one of the ways that you're going to be able to do ethical and responsible business in joint ventures is that if you as the project manager just don't deliver, if the market doesn't deliver, if things don't go the way they're supposed to, and instead of a profit, you have a loss, this is a James Knull opinion because different people do deals in different ways. But my personal ethic is you split that loss. You're on the hook. You're liable for a shortfall if the project doesn't come to fruition properly. That for me is part of my value proposition when I do deals with my partners. And you know, for those of you thinking about doing business partnerships, I recommend building that into your deal as well. Now again, win-win. You want the architecture of the deal to be such that both partners profit together. And that for me is one of the most exciting parts of a joint venture because it motivates you as a working partner, project manager, expert, whatever you like to call it, to do a great job. Because if you want to win, you have to win for your partner. That's why business partnerships are so exciting. So that's phase one. That's the, we're getting into the foundation phase. So this is what you got to do in phase one. So that's kind of the basic terminology and tenets of a joint venture. We're going to talk about the foundation phase. Now the thing about the foundation phase is just like anything else, it takes the most time to do, and if you don't do it properly, everything else that happens after that is going to be an absolute disaster. So take your time during the foundation phase and make sure you tick off all of the boxes I'm about to suggest, because if you miss one of these boxes, I can talk about all kinds of ways this is going to go sour for you as the deal progresses. So number one, letter of intent. I like to have, somewhere in the first couple of conversations, a letter of intent signed. This isn't a full joint venture agreement. but it allows you to prevent yourself from investing too much time in somebody without a very clear understanding of the way business is going to be done. So the kinds of things that go in a letter of intent would be, who's putting in the cash, who's putting in the mortgage, property selection criteria, what the deal split is going to look like, how the cash flow is going to be managed, what the ongoing management is going to look like and who's going to be responsible for it, what the timeline for exit is going to be, who's going to be responsible for the banking, and I highly, highly recommend to get a deposit from your potential partner. This shows that they're serious. This puts cash in the bank that you can use as a deposit on a deal that you're going to buy. And ultimately, it protects you from tire kickers, time wasters. Again, you are putting in a ton of your time to put these deals together. And if you have somebody who said that they want to do a deal, okay, great. Let's put it on paper. It can be a one-pager where you basically draw a line down the middle of the page and write my responsibilities, your responsibilities, and then at the bottom of the page, what I get, what you get when the deal is done. Have them sign off on it, you sign off on it, collect a deposit. That way, at least there is a level of commitment there that lets you know you can proceed. Obviously, we want to get a mortgage pre-positioning. This is what Keaton and Kyle are going to look like. If you show up and say, hey, we've got this deal and there's 10 days left and I've got a partner involved and I own 5 properties and they own 5 properties and it's going to be a little bit complicated. Is that cool? No. No, that's not cool. You need to be pre-positioned so that you're ready to take action. As we all know, really good deals usually don't give you the luxury of long timelines or the ability to dilly-dally as you're writing an offer, or even a longer closing period. Good deals don't last, we know that. So you got to be ready to strike, and that comes with a mortgage pre-position. Another absolutely essential part of phase 1 is going to be getting your legal joint venture document into the conversation. It should have all of the information included in the letter of intent translated into legalese. It should have contingencies if partners default or die. That'll happen. What do you do if they die? Emergency exit protocols. So say that somebody 3 years into the deal all of a sudden says, this bad thing happened to me and I need my money back right now. Okay, that's life. But how are you going to handle it? You want to make all of the hard decisions now while you're getting along great, while there's smiles on everybody's faces, and while you're optimistic so that you don't have to deal with it later. I was gonna give a little nudge here to Richard and Linda. Are they still here or did they leave? Those lawyers. They told me they were gonna hit a patio. Guys, there's a slide right here for them. So here's the thing. Lawyers sink deals. Big time. Big time. You think that the hardest part of doing a joint venture is coming up with your hat in your hand and saying, hey, do you want to give me $100,000 if I give you 15, 20% a year ROI? That's not the hardest part. Well, at least for me, because I'm in sales. That part isn't nearly as tricky. And you think that once you get over that threshold, you're like, okay, it's all easy sailing from here. Well, here's the thing. You get your real estate savvy lawyer at RMLO to draft you up a joint venture agreement that's awesome, that covers all the contingencies, and you give it to your joint venture partner and you're proud as punch and you say, yep, this accurately reflects the letter of intent that you and I signed together. This is just a formality, let's get it done. And then they take it to their cousin Joe, who's a lawyer, who then rips it to a potential partner, completely turns them off of the deal. Obviously they trust Joe more than they trust you because it's their cousin or whatever. And this is your deal. Done. So, the only thing that's going to make that ship sink faster is if you try to do that under a 7-day timeline where there's stress and duress involved. That's why you get the legal going early, so that in the event, which is very likely, that their lawyer has some edits, tweaks, revisions, you're not forcing them to make difficult decisions under a time crunch. Because guess what the answer is going to be in that scenario? Nope. Nope, I'm uncomfortable, this ain't going to happen. So if you can get this going in phase 1 before the offer gets written, then it gives you time to negotiate out the finer points of that joint venture agreement, suss out the problems, and get the confidence level there so that they're ready to sign as soon as there's a deal on the go. This is critical. But once you get over the hump and you get your presentation dialed in and you're very good at getting alignment with people and pitching that deal, this is the biggest hurdle. Every single deal. Every single deal I've done, this has always been a hurdle, and I can tell you guys, you have to have this one dialed in. The other thing you want to start doing in phase 1 is start looking for a property. Again, it's that chicken and egg thing. We're finding partners, getting letters of intent signed, getting them ready to do a deal, but you also want to start poking around looking for deals once you've got at least that letter of intent signed and you know the process is happening. Because if you have very particular criteria for a deal, then it might be 1 month, 2 months, 3 months before the property that ticks all your boxes comes up. And so if you know the more specific you are, the more difficult it is to find your dream deal, then you want to make sure you're shopping for it fairly early on in the process, because while your joint venture partner might be interested now, if you don't actually bring them a deal for 6 months, they're going to say, well, what the heck, I have other places I could be putting this $100,000 to get it to work for me. So that's, you want to run these things in parallel. Now, let's hit our triggering event. We're going to write an offer. This is what gets us into phase 2. So, alert your partner to the fact that you've written an offer. That's pretty important because, again, now instead of a fairly relaxed timeline, you're going to be under a tight timeline. Ensure 100% that they're ready to close. So, as you're writing the offer, just reach out to the mortgage broker, reach out to the partner, make sure the cash is in the bank, just triple, quadruple check those details so that there aren't going to be any snags during your pending period. Use the deposit that they gave you with the letter of intent as the deposit on the property. That's what it's there for. And have buyer and or nominee, or the terminology that RMLO has suggested to me is put a clause in the contract that says, buyer may assign the deal to another buyer on or before closing. Okay, great. There's a couple of different ways to word it, but the fact of the matter is you might not necessarily know who's going to be the final purchaser of this deal yet. And if you have a JV structure in place that involves your partner being on title, then you're going to want the ability to add them on title afterwards. Great. We triggered phase 2. Due diligence. So what are we doing in the due diligence phase? Well, we're going to finalize our financing. We want to finalize our management team if you haven't already picked your property managers. We're going to set up the bank account and accept the reserve fund money into it. You're going to get contractor quotes if needed. And in that acquisition phase, you want to sign the JV contract with the lawyer before you remove conditions. I'm going to say that one more time because it's so important to sign the JV contract with the lawyers before you remove conditions. Otherwise, you're going to end up with my poor client who's going to go unnamed, who's now having a battle over a deal that was done, as far as the law is concerned, over a handshake. You don't want that. You don't want to be in that position. So, assuming all that stuff happens, and you're happy with the inspection and all that good stuff, you get to hit your next triggering event, which is condition removal. Woo! So this is how you can tell this slide shows from a couple of years ago, because this is when the Blackhawks last one to come. And I was pretty excited, so I put the slide. So you remove conditions, and now you go on to the ongoing management of the property. So I'm just going to give you guys a bit of a perspective and outline about what kind of stuff that you need to do as a partner, specifically in a buy and hold deal. So there's all kinds of deals, but again, let's keep it high level, let's keep it simple. What should you have as an expectation of yourself, and what should you be committing to your partner that you're going to do with this deal on an ongoing basis as this deal chugs along for, let's say, a 5-year term. So, you're going to be maintaining the relationship with the property manager. We've got one of my property managers actually here. There's Libertas in the back. Let's give us a wave, Tyler, Carol. Even if you're not managing the property yourself, if you have a relationship with the property manager, how many people here have a property manager hired that manages their property for them? Don't be shy. I know a lot of you do. Exactly. So you have a relationship with them that needs ongoing maintenance, management, communication, all that stuff. You got to maintain that relationship. You want to make sure that you're keeping current with market rent. If you're committing and to attempt a certain ROI, you need to know what the rents are going to be so that you can advise your property managers on when to increase the rent. And you should make sure that you have a vacancy plan. I mean, that's been extra relevant the last 2 or 3 years to have a vacancy plan. But make sure you have a vacancy plan that you can execute when vacancies happen quickly and effectively. We've got cash management. So, as the working partner, you should be doing the bookkeeping. You should be managing and maintaining a bank account for the operating cost of the property. And you should be figuring out what you're going to do with that cash flow. Are you going to pay it out monthly? Are you going to pay it out quarterly? Are you never going to pay it out and just keep accumulating a reserve fund that gets paid out at the end of the deal? Are you going to put it towards mortgage paid out? It doesn't really matter. That's something that you should have figured out early on in your letter of intent phase so that you can manage it later on. So whatever it is that you agreed upon, well, guess what? Now you got to do it. So however you're managing that cash flow, you're executing that. Fixed expenses. Guess who gets to make sure the property taxes get paid? You do. Now here's a cool trick. There are a lot of mortgage companies out there that will collect the money for the property taxes for you and then pay it on your behalf at the end of the year. Super convenient. That's what I do with my properties. Insurance. Obviously, the property needs to get insured. The insurance needs to get paid. Condo fees. If you bought a condo and that's your investment, figure out how you're going to pay the condo fees. Repairs and maintenance. Plan for upcoming capital costs. If you bought an older property, you want a water tank, new shingles, whatever. If you bought a newer property, this is a little bit less management intensive. Complete initial repairs. So again, if you bought an older property, you need to make sure that you're managing the contractor to complete the initial repairs and then facilitating the payment and overseeing the contractors. So again, if you have a contractor that needs to do work on the property, it's your responsibility as the deal manager or the project manager to check it out and make sure the work got done properly. And make judgment calls on the necessity of any other repairs and maintenance. So make sure that you are checking in on the property. I like to go into my properties at least once a year and do my own maintenance checklist just to make sure that nothing's getting missed. You know, have a way to keep an eye on your property and make judgment calls on what's needed. Reporting. So this is a pretty important one. If there's one thing I know about business, and I think pretty much everybody has experienced this at one point or another in their life, it doesn't matter if you did the things you were supposed to do if you didn't tell anybody you did them. I'm a boss. I know what it's like if my employees don't report to me on a regular basis on what they're doing. I was like, what are you doing? Are you doing anything? And then they're like, hey, relax. I'm sure some of you have had bosses who get mad at you for not doing things because you didn't communicate to them that you completed the tasks that were assigned. This is no different. So you need to make sure you tell your partner what's going on once in a while because they want to know how their investment is doing. So you should have made a decision on how often the reporting is supposed to happen. What content is going to be part of that report? Is it going to be financial information, a written report of updates, etc., etc.? Whatever you've committed to put in that report, you need to make sure it's in that report. That could be cash flow, financials, tenant updates, repairs and maintenance updates, even a market update is kind of cool, especially if the market has grown. You could say, hey, Mr. Joint Venture Partner, I called my favorite realtor at the Mogul Realty Group just to get some comps, and it looks like our property went up $50,000 in value. Just thought you'd like to know that. Have a great summer. It's great to share good news. And updates on the proximity to the projected ROI. So if you have said, you know, we're going to gun for 20% per year, maybe your year-end report can say, this was our mortgage pay down, this is the current market analysis for where our property's at, this is how much cash flow we created year to date, this is what our ROI was this year, give or take. People want to know that stuff too. So again, make sure that you set an expectation for what kind of a report you're going to give, and then deliver on that reporting. Now, here comes the fun part. The slide did the thing that it did to Linda. Super fun. Okay. There we go. Our event. Exit. So this is what ends phase 3. So do you sell and cash out? Do you refinance and hold? Do you refinance and use that money for future acquisitions? Well, you should have this baked into your joint venture agreement so that it's set as to what's supposed to happen. But if things are going great and you have an awesome relationship with your joint venture partner and you're making money and the property's doing great and nobody needs that cash for anything in the immediate future, well, maybe it's time to have a conversation about altering your game plan to keep a good thing going. But if you just want to call it after 5 years and take your own money, nothing wrong with that. The whole point of doing this kind of business is obviously to create profit and wealth for yourself in a way that's predictable and sustainable. But the fact of the matter is, you can only buy so much property with the cash that you have in your jeans, and then if you want to grow, you need to work together. And that's the way that you do it in real estate. You create joint ventures, you work together, you do business partnerships, and you move things forward. So again, that presentation came pretty quick, but it's been recorded, it's It's going to be available. The slides will be online, so you can review it. And I am more than happy to answer any questions that you could have.